Hey guys, Sean Terry here, flip2freedom.com. Hope you're doing well. I am in this video going to share with you current real estate market data that just released. And I'm actually going to share with you kind of my story around the previous real estate market crash in 2007, 2008, 2009. And I made some incredibly smart moves, made millions of dollars, and then I made some stupid moves, lost millions of dollars. So what I want to do is share with you what not to do during certain times, because right now is this certain time and there's certain strategies you do not want to do. So if you are brand new to the channel, welcome. We talk about all things real estate. We talk about the stock market. I primarily am a real estate wholesaler, and I've been wholesaling now for the past 20 years. Now, in this video, we're going to look at something which is really interesting. It's current real estate market data. Now, this is Fred data. And you can see right here that these spikes is inventory. So this is monthly supply of new houses in the United States inventory, right? These are inventory spikes. Now, if you look at these gray sections right here are recessions. Here, of course, down here is the 2020 pandemic. Down here is obviously what happened to the real estate market, why prices went through the roof, because we had so little inventory. Now, the interesting thing about real estate is that the inventory, the amount of houses available, is a direct correlation to the pricing of the house, right? So if you have a flood of inventory in the market, prices collapse. If you have less inventory, obviously prices go up, supply and demand. So give you a perspective, back in 2003, when I first got started, the market had super low inventory. Well, let's look at it. Now, in 2003, I got started where is it? Right here in 2003, May of 2003, I got my first check of $11,008 in May of 2003 for wholesaling a house. I got a property under contract. I found a buyer for it. I turned around and sold it, and I made a profit, right? Now, if you look at over here, this was what is called a sideways channel. This little recession right here, it's actually a big recession, but it was the tech sector. Remember 2000, we have 2001. Obviously, we know that the Twin Towers were attacked, so that basically created a recession. We had the NASDAQ crash from like 5,000, I think it was down to like 2,000. But this right here is what's called a sideways channel in inventory. So inventory high was about 4.8, inventory low was in the 3s, and I got started right in May of 2003. So during this time, the market was great, right? Just like this time right here, the market was great. A lot of people got started in real estate after this crash, and they got started in 2012, 13, and they've been doing deals, right, in this sideways market where inventory is about 6 down to about 4, which is a really good time to do deals. All right, so now if we look back at all these different times of these spikes, what happens during these spikes? And we're going to talk about what not to do when it comes to certain strategies when you have these spikes, and then when is this point going to happen where it's going to tip, right? And now the inventory is going to start to decrease dramatically. So first off, where we are right now, well, this was just released, right? And we are currently at 9.3 months supply of inventory. Now, I'm going to give you this link. This link will be in the description below, so you actually can track it and watch it yourself. But the bottom line is, we have 9.3 months supply. And now if we go over, like right here, this is August of 2007 supply. But here's the interesting fact. Look how fast, this is a parabolic move right here. Look how fast this has risen compared to this time where we went down from, 3.4 months supply here, February 2004, all the way up to August of 2007. So So it took about 3+ years to make this move in inventory, where now we went down from 2020 to 2022. It took a little under 2 years actually to make this move right here. So now let's talk about it. So I got started back in 2003. In early 2004, I started a strategy where we marketed to pre-foreclosures. And then what I do is I would get a property under contract with a pre-foreclosure. We pay the seller whatever amount they wanted, $3,000, $4,000, $5,000, $6,000 to move. So we pay them to move. We kept their existing mortgage in place, obviously with their permission, of course. We negotiate this. Kept their existing mortgage in place for whatever term was agreed upon. It could be 3 years, 5 years, 10 years. We had the term of the note. Then we would reinstate that loan, keep that loan in place, and then we clean it up, and then we put a tenant in that property. And during the late 2003, early 2004, all the way through 2004 and early 2005, I built a property portfolio of 120 properties, or $36 million worth of properties. So let me zoom in right here. And I'll zoom in, I'll show you. But during this time right here, actually, my fault, this time right here, late 2003, early 2004, it was a really good time. I basically built that portfolio. And then in 2005, the market went literally insane. Inventory was low, especially here, and this is primarily in Phoenix, Arizona. They had lotteries on houses, on new build houses. There would be, 2 and 3 and 5, sometimes 20 offers on a property. They would have remove appraisal contingencies. They would move inspections. There would be cash offers coming in all over the place. And it was a crazy market. You literally have an open house. So there'd be 50, 60, 70 people at this open house, all trying to buy this one house. So it was insane. Now, it sounds pretty familiar, exactly what happened here back in 2021, at the latter part of 2021. Well, what happened was inventory became crazy low in the marketplace, and it created this massive amount of demand, this rush into buying properties, right? There was this huge demand, and then all of a sudden, you know what happened? Because of that demand, because of the low inventory, it shot up the prices of houses, and prices went, basically parabolic, up to 15, 20% a year. And now the affordability of housing has gone out of control. So if you look at over here in this time right here, I was doing deals, and all of a sudden in 2005, if you look at the inventory, there was about 5,000 units of inventory in Phoenix, Arizona. About 5,000 units, right? Now, if I go back and look at the amount of units of inventory in Phoenix alone, back in December of 2021, there were 4,500 units of inventory. So we're pretty similar in the amount of inventory, and the markets were both absolutely crazy, where you get multiple offers. And this is pretty much all across the country. And we go back to the chart here, we can see why, because look at, inventory was dramatically low, during this whole time. Inventory was low. So when you have this crazy low inventory and you have cheap money in the markets, go back over here to these 30 rates, you have super cheap money over here, and then you have super low inventory over here, then it creates this massive buying frenzy in the market. And it was similar what happened back here. All right. So now what we see is that, in 2005, 2006, inventory started to spike. The housing market started to come unraveled. So how do you know if you're in a housing bubble, right? Basically, this article came out right here from Fortune Magazine. It talks about 3 elements that we're in a housing bubble. If we go in and we talk about the textbook definition of a housing bubble, requires 3 things, right? First, you must see exuberant demand, boost by speculation, rush into the housing market. Number 1, we've got that. Second, spiked home prices would travel well above the incomes can support and reach overvaluation levels, right? So have we done that? Has the home prices reached above where actually people can afford those houses? So we go over here and we look at the homeownership affordability, and we go back here to 2007. Look where the affordability was. It's 7174 back in 2006, right? So the affordability index is super, super low. People can't afford houses because house prices have skyrocketed. Now we go over here. Look at where we are here. Again, we're at super historically low affordability for houses. Well, guess what? That puts us in a second part of the housing bubble. Third, the housing bubble pops and home prices fall. Now we go back and look at, well, the deal is off. Home sales are getting canceled at the highest rates since the pandemic, right? And then we've got more than 40% of home sellers dropping their prices, especially in Sacramento, Salt Lake City, Boise, Sacramento, other pandemic hotspots, right? So we look at that. Home sellers are slashing prices in sudden halt to the pandemic boom. So now we have this storm that's happening right now. And I've been, in the real estate business, I got friends all across the country, and I'm talking to them, and they are in shock of how fast home prices are dropping. It's absolutely dramatic. I actually had a couple houses under contract in Las Vegas, and we were about to, put them out to the market. Then two other houses, nicer houses than ours, larger houses than ours, bigger lots than ours, same exact, subdivision neighborhood, came out for $50,000 less than our acquisition price. Blew the whole deal, right? And those houses are still standing there because there's no demand of people trying to buy houses in that particular area. So they're just slashing their prices. This is the first time I've seen in a long time where the sold price is significantly higher than the list and the pending high price. It's just like insane. The sold price is here, and now the listing and the pending properties are dropping significantly below that price. So if we go back and look, and we want to talk about right now what to do when and why, right? So if we go back right here. So what don't you want to do during this time right here? What type of strategies as a real estate investor do you not want to do? Well, first off, let me share what I did. So I bought all those properties. We sold all the properties in 2005, the 120 properties, $36 million worth. I made millions and millions of dollars during this time right here. I exited the property at the perfect time. We had a group out of California come rush in and buy our properties in basically tranches. They bought 30, 40, 50 properties at a time. And in a matter of a couple months, we literally sold all of our properties at the height of the market. Then what happened? The market shifted like you saw here. And I was actually talking to a friend of mine, and I have two daughters, and both my daughters are in dance for years. And there was a dance dad there that was a civil engineer that said, "Hey, we should get into land acquisition and entitlement." Now, I didn't know anything about land acquisition and entitlement, and I didn't know anything about the current markets. And I was sitting on millions of dollars, and I'm like, okay. I didn't look at the market. I didn't seek any advice. I didn't talk to anybody, mentors, or I didn't watch YouTube videos to try and understand where the market is. So he's like, "Hey, we should do this." Now, unbeknownst to him, he didn't know what's happening in the market. So he didn't know what he didn't know. I didn't know what I didn't know. My partner in the houses didn't know what he didn't know. And what happens is we went in blindly. And what we did was aggressively is we started buying large tracts of land. So I got this one property under contract, a 28-acre property, and we were bringing it through the entitlement process. I bought another property, a 10-acre property. I bought another property. It was like a 13-unit condo, R4A condo unit we were going to develop. Then I bought 138 acres in Tucson altogether, and we bought another 20 acres out by the Glendale Arena where the Super Bowl's played. So we bought all these properties. I went aggressive. We were going after properties like crazy, tying them up, getting them under contract. We were meeting with civil engineers, getting all the streets, curb, road, gutter, all that type of stuff, doing the get site plans, and we're getting it platted, engineered, ready to sell to a builder. Now, what happened in early 2006, if I go back here, in early 2006 right here, our 28-acre property, we brought it through a general plan amendment. We annexed it into the city of, we annexed it in the city of Phoenix. We did a general plan amendment to it, right? Then we did a rezone on the property, taking it from 1 unit per acre to 6 units per acre. We put a 166 platted and engineered rear entry product plot plan on it. And then we did all the streets, road, curb, gutter, and got everything platted, engineered, ready to go. And during this time right here, we sold it to a home builder, Montalbano Homes, that was here in Phoenix, and they were building, and they were looking for this perfect product. A lot of the builders are building this small lot rear entry product. So Montalbano Homes came out, and we were under contract for $12 million to buy these 166 lots, right? We purchased the property for $2.6 million. We had some engineering costs. That was like an all-in cost. And we had 3 partners. So I was roughly going to get a $2.5 to $3 million payday once exit. So we contracted with them. We went in escrow. They had a $250,000 fully refundable deposit, and they actually had a drop dead date to go non-refundable. And I remember I was in Disneyland, and I was hanging out at Disneyland with the family, walking around, and I got a call from Teresa at the title company, and she said, "Hey, I got some bad news." I go, "Oh, great. What?" She goes, "The buyers, Montalbano Homes on your Broadway project, they canceled escrow because of market conditions." So that was the day they were supposed to go non-refundable on their $250,000. And you know what they did? They canceled escrow. That's when the chips fell, right? That's when the dominoes started to happen and the chips fell. And I'm like, oh my gosh, what do I do, right? I was like devastated because I was excited because that was the day they were going to go non-refundable and they were going to close in a matter of 30 days later. I was going to have $2.5 to $3 million wired into my account. That was a big deal. And that was just one project. And I had all these other projects I was working on too. So what happened, right? What happened is the market shifted. The market shifted. Inventory was increasing. They were in the know. They decided not to purchase the property. And then guess what? I was stuck now with this property, and I had all these other properties we were dealing with, and I was cutting checks for $100,000 a month. And literally every single day I was looking in the newspapers trying to find any signs of hope that the real estate market was shifting. Right. So we're going to talk about this right here. So as the market came on, I kept on looking for signs of hope. And then what happened? Labor Day 2008 was the bottom. I pretty much ran out of money. We're cutting checks, keeping everything, trying to keep for about almost 2 years, a year and a half. I went to meetings with lenders. We talked to them what we're trying to do. We're waiting for the market to turn. I was looking for signs, and I'm cutting checks literally for interest just on all these properties, trying to keep everything together. And it finally came where I was completely out of money. Now I stopped wholesaling houses. I was too big for my britches. I stopped working out. I was just stressed. I figured out like the more work I do, the better. I just got to dive in. I just got to try to do some more. But I was doing the wrong things. I didn't get back to the core of actually wholesaling. I started during this time right here, and working to get back into it, but I was spending more time trying to save these properties than I was actually working on generating revenue. So it came to the point where it's Labor Day of 2008. I remember that, vividly. I was sleeping in. I wasn't waking up. I wasn't praying in the morning. I wasn't doing my morning ritual. I wasn't tithing, giving. I was literally just in survival mode, trying to figure out how these properties, going to meetings with all these different lenders and trying to keep everything at a bay. So what happened was on that Labor Day morning, I got a knock on the door. I was like, oh, crap, right? I woke up, I threw on my hat. I'm in my boxers, threw my shirt on, came out, opened the door. It's all bright outside. I'm like, what do you looked at the door, and it's this thug looking dude at the door. And he comes and he says, I'm here to repossess your car. And I'm like, oh, and I literally start, adrenaline starts shaking, my adrenaline shaking, and I start scrambling, looking for the key. And I held him off. Luckily, I held him off. And I said, hey, just give me a bit. So I called the company that had the loan on it. And I'm like, yeah, listen, you just gotta hold this thing off. So they gave me till Friday, until I could make it was like a $1,200 payment. I didn't even have $1,200 to make my car payment, which is insane. So that was the bottom for me. So what I learned during this whole entire process of what not to do. So what don't you do here? Well, first off, you don't buy land with debt, right? You don't buy land with it. Now, you can buy land and bring it through the entitlement process, but if you don't have to service the debt, if you maybe don't have to pay property taxes, or maybe you can afford the property taxes, don't buy land. But even if you're buying land through here, the value of the property is decreasing, because as inventory increases, the housing prices around that particular land, depending if it's commercial or not, is actually decreasing as well. So I personally would not buy land right through this right here. I wouldn't be doing subject twos through this time right here. I wouldn't, be buying the BRRRR method and be buying houses as inventory increases right here. I wouldn't do it. Would I buy 3 and 4 and 5 unit apartments? It'd have to cash flow significantly. So now I know people that's been buying houses, during this time frame right here. If you got 50% loan to value and it cash flows each $500 to $1,000, and you got plenty of room and plenty of cash in the bank just to have any cash reserve, then great. But what if this is worse? This parabolic move keeps on going, and now it's going to go up and down just like this, right? So this is going to go up and down. But what if this parabolic move, we're at 9 months supply right now in such a short period of time? It's dramatic. So we've got basically 3 more months of supply, and we're all the way up here, and it's starting to shock the real estate market because it's happening so fast. What if we go even higher? Now, Federal Reserve now is going to be raising rates tomorrow, right? And then they've got, 5 or 6 more rate hikes down for the rest of this year. Now they could stop and they could pause after this if inflation comes down a little bit, but who knows? But they still have to pull out of the market $4 trillion out of the market. So here's the big problem is the Federal Reserve right now, from this pandemic time, they had a $4 trillion balance sheet. And because of the 2020 pandemic, pumped $4 trillion and doubled their balance sheet. And what happens is now they have to basically pull the money out of the market, which essentially is going to drive us into a deep recession, right? You pull that much money out. Well, what happens if you pump the money in the market? Well, we all know what happens. Stock market goes like crazy, right? We got the stock market that goes This right here is what's called quantitative easing, right? This is where the stock market right here, they started pumping money at 260 and it went all the way to 480. And now this is called quantitative tightening. Now they're pulling money out of the market right here. And now it could turn up and then come back down. Who knows what's going to happen? But as they pull money out of the market, it's going to make a difference in valuations. So if you look at, the Federal Reserve, when they pump money in the market, equities like stock market, commodities, and real estate prices increase, right? When they pull money out of the market, those same equities collapse. And that's exactly what's happening now. They started a quantitative tightening protocol in early January, and now they've been on a rate raising campaign. Rates have now increased, and they're pulling money out of the market, and that money now is starting to collapse the market. And we're seeing it in real estate, and we're seeing it in commodities, and we're seeing it in the stock market right now. So We're going to talk about that. So if we go back to the chart right here, what don't we want to do is we don't want to, in my opinion, this is my opinion, right? I don't give it financial advice. In my opinion, I would not be buying, houses right now. I wouldn't be buying duplex, threeplex, fourplex. I wouldn't be using seller financing or subject to properties. I wouldn't be buying land or other assets right now. I when it comes to the real estate market, I would be sitting on the sideline unless you're going to wholesale houses. Wholesaling houses or wholesaling other real estate. You can get land under contract and turn around and flip it. You can get apartments under contract and turn around and flip it if you get it at a good price. But the bottom line is I wouldn't be buying to hold any long-term assets. Now, I look back historically during this time right here and what survived as an asset class in real estate during this time frame. It was student housing because people went back to school, and it was mini storage because there was displacement, right? There was a lot of foreclosures. There is displacement in the marketplace. So now I would build mini storage. I am looking for land, right, to build mini storage, right, at a good deal. And I want to essentially entitle the property and then build during a recessionary time frame instead of build when there's massive amounts of demand and inflation as well. So now, obviously, we know inflation is like crazy. So the bottom line is this period of time, there's certain things you don't want to do. You want to wholesale your brains out like crazy. And then there's going to be the pivot. The question is, when is that pivot going to happen, right? What is the sign? What is the signal for that pivot to happen? And in my opinion, from looking at previously what happened, that happens when the Federal Reserve comes out and they change from the policy of quantitative tightening and they go to quantitative easing. So what I believe is going to happen is we're going to go into a recession, right, in 2023. It's going to happen in the next 8 to 12 to 18 months, right? So about 8 to 18 months, we're going to go into a recession. There are basically two indicators of us going into a recession. Number one is what's called the inverted yield curve. The inverted yield curve is when the 2-year note, treasury note, produces a higher yield than the 10-year treasury yield. Now, it's interestingly enough, if you look at the yields as of today, the 2-year yield produces higher than a 30-year and a 10-year. So we are massively inverted right now on the inverted yield curve, which is a indicator of a coming recession in the next 8 to 18 months. Okay. The second thing is roughly $100 a barrel oil. That $100 barrel oil puts us into a recession. So we have two for sure indicators showing us that we are going into a recession. And now even the White House changed the definition of a recession. Now tomorrow, I think it's either tomorrow or Thursday, we actually come out with our GDP. And the GDP, they're saying it could be positive, it could be negative. I don't know what it is, but if you have 2 quarters of negative, we're considered in a recession. I personally don't think we're going to hit the big recession until sometime next year, mid to late next year is when we're actually going to be in the full-blown recession based upon the current kind of indicators I'm looking at right now. So by definition, we could be if we get a negative GDP, but I don't think we're going to get into a massive one until next year sometime. So now there's a couple different things that we have right here. So what is that indicator? What is that indicator that makes this pivot right here? The indicator is when we're in that recession sometime next year, the Federal Reserve is going to come out and they're going to rush in and they're going to do a rate lowering campaign, an interest rate lowering campaign, and then they're going to pump money in the market via quantitative easing. So your telltale sign is when they do quantitative easing, that's when you can pivot and start buying real estate, right? So what I'm going to do, my plan, and I have the plan what I'm going to do is I'm going to look for large tracts of land to entitle during this process right here, right? I'm going to look for houses, foreclosure houses or whatever houses that I can buy and subject to the existing loan, and I can own those properties and I can get an interest rate on the property and I can hold that interest rate. If you do subject to, I can potentially have an interest rate where the interest rate was first right here. So if think about this, as interest rates spike and as they continue to go up, which they're going to do, but if I can get someone that has an interest rate that's in the 2 to 3 to 4%, then what can happen is I can take a property subject to the existing loan. They have a 2 to 3% mortgage while interest rates are up maybe to 4, 5, 6, 7%. And now I can take over that existing debt. I can turn around and use it as a rental at this time right here. And then I'm going to get forced appreciation because of the market. I can buy it at a discount, which is good. And during this time right here, then I'll figure out when the market gets down to 3-4 months supply, I can determine if I want to sell those properties. So those are a couple different plays. I'm going to look at land acquisition entitlement. I'm going to look at subject to properties I can buy and then hold on to through this market correction. As inventory decreases, you're going to see, and the quantitative easing happens, then we can take that and we can sell those properties at a significantly higher price. For an example, in Phoenix, you could buy houses in Phoenix during the 2008, 2009 crash in here in Phoenix, in certain markets here in Phoenix, for about $20,000 to $30,000. Those same houses here down in this era and down in this era right here are worth between $280,000 and $300,000. So what if you bought theoretically 10 houses, right? 10 houses, right? That's, pretty good. So you buy 10 houses, $200,000 of houses for $20,000, right? And if you go out and do that, then how much equity would you have, right? You would have down here, if you sold it for 280, so that would be 200,000 turned into 2.8 million. Now, the cool thing about doing this right here, if you're going to do you're going to keep the existing loan in place, you can have it rented during that time frame. You're going to have the forced appreciation. Plus, if you contract and do it right, then you have the ability to turn around and potentially lease option the property, and you lease option that property for 18 to 24 months. You can get a larger down payment and you have minimal cash out of pocket to be able to structure this particular deal. So I usually talk about that in our events or things we do, or maybe our masterminds and stuff. But the bottom line is there's a lot of different plays when the Federal Reserve comes out and says they want to do quantitative easing. That's your signal to start buying some properties. All right. So now we look at what could be a catalyst, right? So the catalyst is the Federal Reserve now pulling money out of the market. That's a catalyst, right? Another catalyst is the potential foreclosures on the market. So let's look at it. So if we go right here, you'll see it says foreclosures surge 181% since March of 2020. Now this, let me see. There's no date when this was written. Oh, right here, April 22nd. So this is from April. Now, an interesting fact, this happened 181%, highest level since March. This is in April. In March, the moratorium was lifted, right? So in March of 2022, the actual moratorium was lifted, and now you're seeing just a little bit of foreclosures going through, but typically it takes 60 to 90 days for those foreclosures to hit. Now, check out this. Here's a recent chart. If I go back right here, we go to this, right? This is 2008, and you see 1.3, 1.5, 1.6, then it dropped in 2011, 2012. So this was the bloodbath when we had all those foreclosures. Then it went down, we have a downward trend right here, and then it went all the way down in 2021 because they essentially stopped doing foreclosures, the moratorium, right? There's actually only 65,000. So then this is 2022. This is the first half of 2022, right? And look at increased foreclosure activity in the first 6 months of 2022 approaches pre-COVID levels. Now we look at this. Now, I think this is going to be even higher because in March they didn't even have hardly any foreclosures because they just lifted the moratorium. So this is March. You got April, May, June. This is 3 months of data, maybe 4. So you got 4 months of data, and it's already increased that much. So if we just double that, that's 330,000. If we go back, that puts us right about here to 2018. So now all of a sudden, bam, it goes up to this point right here. Now, this is a trend reversal. So you got a trend that's going down, right? And then all of a sudden we get a trend reversal. So what do you think 2023 is going to look like? Well, we got to look at, these foreclosures, and as these foreclosures hit the market, what's going to happen? It's going to create what? More inventory. So this inventory is not even including the foreclosures that are actually hitting the market. So if you have more inventory that's hitting the market with these foreclosures, and you have a higher interest rate, and you have inflation, and there's less buying power for people that purchase houses, and you got this whole dynamic of everything going on in the world right now, what's it going to do to overall real estate prices? We're going to see, again, a parabolic move. As inventory increases, it's going to put massive pressure on pricing. And for us real estate wholesalers, it's a good thing. As us for real estate wholesalers, we're able to contract low and sell low, right? Meaning if we have to get the property at 50% and sell it for 60%, we can still do it. We can get the property for 60% of Zillow and turn around and sell it for 70% of Zillow, and we can still do it. The only time you get in trouble when the market's shifting like this is if you're in a fix and flip business, or if you're in a buy and hold business and you are highly leveraged, which I don't agree. I don't think you should be highly leveraged going into a market like this. I would deleverage as fast as I humanly possibly could. And then I would focus on doing wholesaling unless you found smoking deals. We have a super low loan to value. So we look at what's going on right here. I can tell you wholesaling right now is the perfect business model to be in, understanding how to do it, especially on a nationwide scale like we do. We're talking to people all across the entire country, and now it's a buyer's market, so we can be frank on what we're going to offer. We're going to, this is our number, this is what it is, this is how our terms work, and now sellers are moving to us and our offers than us having to try to finagle 5, and compete against 4 or 5 or 6 other buyers that want that property. So the bottom line is that we are in a good position as a real estate wholesaler. And I hope this video helped to give you a little bit of perspective. I'm highly passionate about it, that you don't have to go through what I went through because I did the wrong strategy. Now we can capitalize on the right strategy, put ourselves in a position, and then turn around and crush it and literally set ourselves up. Imagine you buy 10 houses, you buy 20. What if you buy 200 houses, right? And then you turn around. I mean, we're talking, $2 million turned into $40 million because of the way this is set up. So I hope this video helps. I really appreciate it. The links are below for these. I'll give these, put them on Chelsea so you can have these links and you can check them out and you can watch them as this inventory increases. Otherwise, make sure you subscribe, press the like button, and I'll see you guys in the next video. God bless.